S&P index breaks below 50 DMA, ending uptrend. On Tuesday, the S&P index closed down 6,670.32 points, or minus 0.83%, marking its fourth consecutive decline, the longest losing streak in 3 months, and decisively broke below the 50-day moving average 50 DMA at 6,709.81 points, widely regarded as the bull-bear dividing line. This move ended a 138-session upward trend along the moving average. Since February, except for April's extreme volatility, this line had served as the last defense for the bulls. The market has officially shifted to a cautious risk-off sentiment. Lingering doubts over the ROI of AI-related capital expenditures have pressured tech valuations, while Home Depot's weak guidance shattered the illusion of resilient consumer spending, exposing vulnerabilities in the U.S. housing market and discretionary consumption under high interest rates. Sector-wise, technology and consumer discretionary stocks were the hardest hit. In contrast, defensive sectors such as utilities and consumer staples held firm, reinforcing the classic risk-off rotation and signaling a sharp decline in risk appetite. Tuesday's session showcased the bears' dominance. Although the market attempted a rebound early in the day, briefly recovering some losses, intensified tech selling in the afternoon drove major indices to close near their intraday lows. This gap down and fade pattern typically reflects extremely weak overnight holding sentiment. Specifically for the S&P 500, breaking below the critical 50 DMA support, 6,709.81, has turned the short-term trend bearish, with momentum indicators deteriorating. The first line of defense now lies at the 6,600 level. If this fails to hold on Wednesday, bears could push further. The key support is at 6,500, which marks October's previous low and a critical Fibonacci retracement level. A break below 6,500 would form a double top or more complex topping structure, opening downside potential towards 6,430, 23.6% Fibonacci retracement.